Hello, everyone. My name is Tia Lewis, and this is my financial analysis for my FIN381 project. For this project, we had to analyze four companies using information from Bloomberg. The first part is choosing who we wanted to lend a short-term loan to. We have $200,000 to lend, and the companies want $100,000, $100,000 6-month loans. The next part was lending a long-term loan to the companies. We have $1 million to lend, and the companies want $500,000 5-year loans. The last part is deciding who we want to buy equity into or invest in. The four companies I will be evaluating are Walmart and Coke, which are the two we chose in class, and Amazon and Google, which were my picks. When deciding which company I wanted to lend the short-term loan to, I had to evaluate the short-term solvency of each company by using the following liquidity ratios. The current ratio is current assets divided by current liabilities. The quick ratio is current assets minus inventory divided by current liabilities. And the cash ratio is cash divided by current liabilities. So here's my chart for the four companies' current ratio over a 5-year period. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. Unlike other ratios, it incorporates all assets and liabilities. At first glance, we can see that Google's numbers are a lot higher than the other companies. Walmart having all of their numbers less than 1 means they have more liabilities than assets, and also that their network and capital is negative. Next, here's the quick ratio. This is pretty much the current ratio, but it subtracts inventory. By looking, we see again that Google's numbers are much higher. The other companies are so low because they have a lot of inventory. Google is a search engine, so if they do have inventory, it's a very, very small amount. And our last liquidity ratio is the cash ratio. This ratio measures the company's ability to pay current liabilities using cash on hand. Having a cash ratio of less than 1 means there are more current liabilities than cash, and all of my companies are less than 1 except for, as you can see, Google. And on who I decided to lend the short-term loan to Google. They're very liquid and have very little inventory. They're able to pay their short-term obligations very easily. The next part of the project is deciding which company to lend a long-term loan to. We need to find out how much debt they have and can they afford it. We need to use the two leverage ratios listed here. The equity multiplier equals total assets divided by total equity, and the times interest earned ratio equals earnings before interest and taxes divided by interest. The first leverage ratio is the equity multiplier, which is the measure of how much debt. By looking at the chart, we see that Coca-Cola's numbers are the highest, meaning that more of their assets were funded by debt than equity. Companies with a higher equity multiplier are more risky for investors. Google has the lower multiplier, which is always more favorable. The times interest earned ratio indicates how many times a company can make interest and debt service payments with its before tax income. So this is the measure of can they afford their debt. Coca-Cola, who had the highest equity multiplier, now has the lowest times interest earned ratio, meaning they're having a hard time than others affording their debt. Google, on the other hand, had the lowest equity multiplier, but now has the highest times interest earned ratio, meaning they're they are affording their debt easily. And for this, I actually decided to choose two companies to lend the long-term loan to, which are Google and Walmart. I'm lending to Google for the obvious reason their times interest earned ratio exceeded their equity multiplier by a lot, meaning they're easily affording their debt. I chose Walmart because while their numbers were not as great as Google, they have the highest asset turnover rate and they also can afford their debt. I'm mentioning the times interest earned ratio, not the times interest earned ratio, the asset turnover rate right now, but this I'm going to have a chart a little later in the presentation. The last portion of the project is deciding which company I want to invest in. We'll be looking at several ratios. The return on equity equals profit margin times total asset turnover times equity multiplier. The return on assets equals the net income divided by total assets. The total asset turnover equals sales divided by total assets. The profit margin equals net income divided by sales. And the price earnings ratio equals the price per share divided by earnings per share. Return on equity measures how profitable a company is by calculating how much profit a company generates with the money the shareholders have invested. It's ideal to have a higher ROE because it means the company is using its investors' money effectively. As we see, Walmart and Coca-Cola are pretty steady at the top. Amazon went negative in 2 of the years, which isn't good. So, I wanted to take a closer look at Amazon because of the negative numbers and Coke because of the decline, then big rise in numbers to find out what was driving the numbers. Breaking down the ROE equation, I found out that the 2 years the ROE for Amazon was negative, so was the profit margin. So that's the reason for it being negative. For Coke, they had a decline from 2012 to 2013, which was caused by the equity multiplier. It stayed down for 2 years, then had a big increase. All factors contributed to the ROE rising, especially the profit margin. Next, here's the return on assets, which measures how efficiently a company can manage its assets to produce profits during a period. As we can see, Google has the higher numbers. While they're declining, they're still higher. Walmart, they decline a little, but they're very consistent. A higher ratio is more favorable to investors because it shows that a company is more effectively managing its assets to produce greater amounts of net income. Next is the total asset turnover. This ratio shows how efficiently a company can use its assets to generate sales. So the higher the asset turnover ratio, the better the company is performing. Looking at the four companies, Walmart is in the lead from what I talked about in my reasons why I chose Walmart for the long-term loan, with Amazon trailing right behind. Google's numbers are the lowest, but they are not negative, so they are still generating sales, just not as much as the other companies. The profit margin ratio shows what percentage of sales are left over after all expenses are paid. Google has the most. Amazon went negative, as you remember I talked about earlier also. Last but not least, the price earnings ratio. This ratio shows the company's growth potential and what the market is willing to pay for a stock based on its current earnings. Walmart and Google's numbers are consistent. Coke's numbers are steady. Then it doubles in 2015. Amazon's numbers are the highest, meaning investors are anticipating higher growth in the future. And I decided to invest in Walmart. While they didn't have the highest number in every section, they were consistent and a great choice to invest in. This concludes the presentation. I've learned so much from this project, from all the research I had to do to actually analyzing each company. Thanks so much for watching.